Silver just jumped 4.45% in a single trading session. But that is not the number that matters. Somewhere inside a research desk on Wall Street, a number was quietly removed from a public report, a number tied to a shortfall, 46 million ounces of it. And if this number is real, the silver you're holding right now is worth more than the market is telling you, or the entire pricing model is about to break. Wall Street knows which one it is. They are not saying. By the end of this video, you will know exactly what they are ignoring and why they cannot afford to say it out loud. Welcome to the Currency Arc Insight, the channel dedicated to decoding what precious metals markets are really signaling long before mainstream coverage catches up. If this is your first time here, hit subscribe because the analysis in this channel exists nowhere else in this format. And before we go further, drop a comment and tell us which city or country you're watching from today. This channel is followed by serious investors and business decision makers across the world, and we want to know exactly where this warning is landing. Now let's get into it. On a quiet Wednesday morning in July, something unusual happened in the silver market. Prices did not creep up in the slow, predictable way traders expect. They jumped. In a single session, silver climbed by more than 4%, closing near $59 an ounce. For a metal that most retail investors treat as gold's quieter cousin, this was not a small move. It was the kind of jump that makes professional traders stop and check their screens twice. What made this moment strange was not the size of the increase. Markets move sharply all the time. And what made it strange was the environment surrounding the move. The US dollar was strong that week. Bond yields were elevated, sitting at levels that usually pull money away from precious metals and toward interest-bearing assets. Under every textbook model taught in finance programs around the world, silver should have struggled to rise under these conditions. Instead, it surged. For a business owner or an aspiring entrepreneur watching from the sidelines, this contradiction matters more than it first appears. Markets are supposed to be logical systems. Prices are supposed to reflect known information processed by thousands of participants competing to find the truth first. When an asset moves in a way that defies the accepted logic, it usually means one of two things. Either the market is wrong and will correct itself soon, or the market knows something that has not yet been fully explained to the public. Analysts who track institutional trading desks noticed something else that week. Large volume trades in silver futures were being placed by parties who typically wait for confirmation before acting. These are not retail traders chasing a headline. These are desks with research teams, data feeds, and risk models built specifically to avoid emotional decisions. When professional capital moves ahead of a public explanation, it is worth asking why. Meanwhile, gold, the metal most associated with safety and caution, remained largely unchanged. It held near $4,100 an ounce, neither rising sharply nor falling back. This is an important detail. If fear alone were driving investors into precious metals, both gold and silver would likely move together. They did not. Silver moved alone, and it moved fast. This divergence is the heart of the puzzle this video sets out to examine. Something specific to silver, not to precious metals in general, appears to be driving the price, and whatever that specific factor is, it has not yet been widely reported in mainstream financial media. Most headlines that week focused on the percentage gain itself, treating it as a curiosity rather than a signal. Few asked the more important question. Why now? Why silver? Why this size of move at this exact moment against a macroeconomic backdrop that should have worked against it? For someone building a business, managing capital, or simply trying to protect the value of their savings, this kind of unexplained market behavior deserves attention. Prices rarely move this sharply without a reason. The absence of a clear public explanation does not mean there is no reason. It often means the reason has not yet reached the people who need to hear it most. This video will walk through the pieces of the story that connect to this single moment. It will examine a number tied to the global supply of silver, a number that has been present in industry reports for months, but rarely discussed with the seriousness it deserves. It will look at why large financial institutions may be more aware of this number than they are willing to admit publicly. And it will explain why this particular price jump may not be a one-time event, but the early sign of a longer and more significant shift already underway. The next section begins with that number and why it changes the way serious investors should be thinking about silver right now. To understand why silver moved the way it did, it helps to step away from the price chart for a moment and look at something far less exciting, but far more important. Supply and demand. Not the version taught in a first-year economics class, but the real, physical version involving mines, factories, and warehouses that are running low on a metal. The modern world depends on more than most people realize. For several years now, the global silver market has been producing less silver than it consumes. This is not a rumor or a theory. It is tracked and published by industry researchers who monitor mining output, industrial usage, and investment demand across the world. According to recent projections, the shortfall for this year alone is expected to reach around 46 million ounces. That means the world is set to use 46 million more ounces of silver than miners are able to pull out of the ground and refine. A number like this can sound abstract to someone who does not work in commodities, so it helps to put it in plain terms. Every year, the gap between what the world needs and what the world produces grows a little wider. Mines cannot simply increase production overnight. New silver mines take years to explore, permit, and build. Existing mines are aging, and many produce silver only as a byproduct of mining other metals like copper or zinc, which means silver output is often tied to decisions made for entirely different reasons. At the same time, demand for silver has been quietly climbing from an unexpected direction. Most people still think of silver mainly as jewelry or coins, but today, silver plays a critical role in solar panel manufacturing, electric vehicle components, and advanced electronics. As countries around the world continue building solar infrastructure and expanding electric vehicle production, industrial demand for silver keeps rising year after year, regardless of what happens to its price as an investment. This creates a very different kind of market than the one most casual investors imagine. Gold is often bought and sold based on fear, confidence, or expectations about interest rates. Its physical use in industry is minimal. Silver is different. It carries both identities at once. It is a monetary metal bought by investors seeking safety, and it is an industrial metal consumed permanently by factories that melt it down into solar cells and circuit boards, never to be recovered in the same form again. This dual identity means silver faces demand from two directions that rarely slow down at the same time. When investors buy silver out of caution, industrial buyers are still placing orders for their production lines. When industrial demand rises because of a global push toward renewable energy, investment demand does not need to disappear for the market to tighten further. Both forces can pull on the same shrinking supply at once. This is the story that a single day's price jump cannot tell on its own. A 4% move in one session looks like noise unless it is placed inside this larger picture. When a market has spent several consecutive years consuming more than it produces, and that gap is documented, tracked, and projected to continue, price moves start to look less like speculation and more like a market slowly recognizing a scarcity it has underestimated for too long. For a business owner or an investor thinking seriously about where to allocate capital, this distinction matters enormously. A short-term price spike driven by rumor tends to fade. A price move driven by a structural multi-year supply deficit tends to persist because the underlying imbalance does not correct itself in a single trading session. It corrects itself over years through higher prices that eventually make new mining projects profitable enough to build. The question this raises is simple but uncomfortable. If this deficit has been visible in industry data for months, why has it received so little attention in mainstream financial coverage? And more importantly, who has been paying close attention to it quietly while the rest of the market looked the other way? If the numbers behind silver's supply shortage are available in public industry reports, a reasonable question follows. Why has this deficit not become a bigger story in mainstream financial media? Why are the analysts on major networks still discussing silver mainly in terms of daily price swings, rather than the structural imbalance sitting underneath those swings? The answer has less to do with secrecy and more to do with incentives, and understanding those incentives reveals something important about how modern markets actually work. Large financial institutions do not operate the way individual investors imagine. A bank or a major trading desk holding a significant position in silver is not simply hoping the price goes up. It is managing exposure across dozens of related markets at once, from currency positions to interest rate bets to other commodities that move in relation to silver. Publicly declaring a bullish view on silver, backed by a specific supply deficit figure, is not a neutral act. It can accelerate the very price move the institution may be trying to build a position around quietly before the broader market catches on. This is a pattern that has repeated itself throughout commodity market history. Large buyers rarely announce what they know while they are still accumulating. Instead, they build positions gradually, often over months, avoiding public statements that could draw attention to the trade before it is complete. Only once a position is largely established does public commentary begin to shift, and by then, much of the early price movement has already happened, benefiting those who moved first. There's also a structural reason for the silence that has less to do with strategy and more to do with how financial media itself operates. Daily market coverage is built around daily events. A single percentage move makes for an easy headline. A multi-year supply deficit, tracked through mining data and industrial consumption reports, does not fit neatly into a short segment or a quick alert. It requires context, patience, and a willingness to explain a slow-moving trend rather than a dramatic one-time event. Most coverage is simply not built for that kind of story, regardless of how significant the underlying data may be. This does not mean something hidden or improper is taking place. It means the information exists in a form that rewards those willing to look for it directly, rather than those waiting for it to be summarized by headlines. Industry reports on silver supply and demand are published by organizations that specialize in tracking mining output and consumption trends. These reports are available to anyone willing to read them, but they require effort, and most casual investors rely instead on price alerts and short news segments that rarely connect a single day's move to the deeper trend behind it. History offers a useful comparison here. In past cycles across other commodities, from oil to certain industrial metals, sustained supply deficits often persisted quietly for extended periods before triggering a major price adjustment. In each case, the underlying data had been available well before the price move became impossible to ignore. Those who had already done the work of reading the data early were positioned ahead of the shift. Those relying only on daily headlines tended to notice only after much of the move had already occurred. This is the uncomfortable reality facing anyone trying to understand silver's recent behavior. The 46 million ounce deficit is not a secret. It is simply not being packaged into the kind of story that spreads quickly. Institutions with the resources to analyze this data directly have likely understood its implications for some time. Retail investors, business owners, and everyday savers relying on conventional financial media are often the last to connect the dots. This raises the central question this video is building toward. If the deficit is real, documented, and already shaping institutional behavior behind closed doors, what does history suggest happens next once a structural shortage like this becomes impossible to ignore? That is where the final analysis in this series will turn next. Every structural shortage carries its own history, and silver is no exception. To understand what may lie ahead, it helps to look backward at other moments when a commodity market spent years quietly building a supply deficit before that imbalance became impossible to ignore. These patterns do not guarantee an outcome, but they offer a framework. And for serious investors, a framework built on historical precedent is far more valuable than a guess based on a single day's headline. Commodity markets tend to follow a similar arc when a genuine supply deficit takes hold. In the early stages, prices barely react. Producers continue operating as they always have. Consumers continue buying as they always have, and the shortfall is absorbed quietly through shrinking inventories sitting in warehouses and storage vaults. This stage can last for years, and it often does, because inventories built up during earlier periods of oversupply act as a buffer, masking the true severity of the imbalance from casual observers. Eventually, that buffer runs thin. Inventories that once absorbed the gap between supply and demand begin to shrink to levels that make buyers nervous. At this stage, the market shifts from quiet accumulation to active recognition. This is often when the price moves that once seemed unexplainable start to make sense in hindsight. A single sharp jump, like the one silver experienced recently, frequently marks this transition point, the moment where a slow-moving structural story begins to express itself through fast-moving price action. This pattern has appeared before in other corners of the commodity world. Industrial metals with long production timelines have gone through similar cycles, where years of underinvestment in new supply collided with steadily rising demand, eventually producing price moves that caught most casual market participants off guard. In nearly every case, the underlying data had been visible well in advance. The surprise was never the deficit itself. The surprise was how quickly prices moved once the market finally acknowledged what the data had been showing all along. For silver specifically, this history carries additional weight because of its dual role as both a monetary and industrial metal. A deficit in a purely industrial commodity can sometimes be resolved through demand destruction, where high prices eventually force factories to use less of it or find substitutes. Silver's role in solar panels and electronics makes substitution difficult in the short term, since these technologies are engineered around silver's specific properties. At the same time, its role as an investment asset means that rising prices can attract additional buying interest rather than discouraging it, a dynamic that is far less common in purely industrial markets. This combination is worth sitting with carefully. A structural deficit that is difficult to solve through substitution, paired with a metal that draws in more buyers rather than fewer as its price rises, describes a market with very different dynamics than most commodities most investors are familiar with. It does not guarantee a dramatic outcome, but it does explain why serious analysts view this deficit differently than a typical supply and demand imbalance. None of this should be read as a prediction of a specific price target or a specific timeline. Markets remain unpredictable, and structural deficits can persist for longer than expected before fully expressing themselves in price. What this analysis offers instead is a way of thinking. A business owner or investor evaluating silver today is not simply reacting to a single day's 4% move. They are looking at a documented multi-year supply gap, a pattern of institutional behavior that suggests quiet awareness rather than public alarm, and a historical precedent showing how these situations have unfolded in other markets before. The number Wall Street has been quiet about is not hidden. It has been sitting in industry reports, available to anyone willing to read past the headlines. What remains uncertain is not whether the deficit exists, but how much longer the broader market will take to fully price it in, and who will have positioned themselves before that recognition becomes widespread. The final section will bring these threads together into a single closing perspective.